Seller financing, also known as owner financing, is a real estate agreement where the seller acts as the lender, providing financing directly to the buyer. Instead of the buyer getting a loan from a bank or mortgage company, the buyer makes payments directly to the seller over a set period of time. This can be an appealing option for both parties under certain circumstances. For the seller, it can help sell the property faster, especially if traditional buyers are having trouble qualifying for a conventional mortgage. For the buyer, seller financing can provide an opportunity to purchase a home even if they have difficulty securing a loan through a bank or lender. In a typical seller financing agreement, the seller and buyer agree on the purchase price, the interest rate, the down payment, and the length of the loan. The buyer will then make monthly payments to the seller, usually with interest, just like they would with a traditional mortgage. The terms of the agreement are often more flexible than a bank loan, which can make it easier for both parties to negotiate. One key benefit of seller financing is that it can bypass traditional lending requirements, which may be difficult for some buyers to meet. This is particularly helpful for buyers with less than perfect credit or self-employed individuals who may struggle to prove income in the way banks require. Seller financing also allows buyers to avoid certain fees and closing costs typically associated with traditional mortgages, which can make the home buying process cheaper and quicker. For the seller, offering financing can make their property more attractive to a broader pool of buyers, especially in a tight market where many buyers might be unable to get bank financing. Sellers can also potentially charge a higher interest rate than traditional lenders, which can be a benefit if they're looking to earn more from the sale. However, there are some risks for both parties involved. From the seller's perspective, there is a risk that the buyer may default on the loan, leaving the seller to pursue legal action to reclaim the property. To protect themselves, sellers often require a larger down payment or a shorter loan term. Sellers can also include clauses in the contract to ensure that if the buyer defaults, they can regain the property through foreclosure. For the buyer, there's a risk that the seller may not have the financial stability to back up the loan, which could cause complications down the line. Buyers should ensure that the seller owns the property outright and has the financial ability to fulfill the terms of the financing agreement. It's also important for both parties to have a clear and legally binding contract in place. While seller financing can be a great option for some buyers and sellers, it's important to approach the agreement with caution. Both parties should fully understand the terms of the deal and seek legal advice to ensure the agreement is fair and legally enforceable. Additionally, it's essential for buyers to keep up with their payments, as failing to do so can lead to losing the property. Seller financing can offer flexibility, faster transactions, and an alternative path to homeownership for buyers who might not qualify for a traditional mortgage.